You know, you see these huge companies everywhere, right? The ones with the slick ads and the giant, shiny buildings. And you have to wonder, are they actually successful, or is it all just for show? Well, figuring that out is the secret to making really smart moves, whether you're looking to invest, run a business yourself, or even just understand the world a little better. And today, we're going to do just that. We're going to pull back the curtain and learn how to read their real story.
So how do they do it? It's not a guessing game, I promise you. They've got a tool that lets them see what's really going on. See, they're reading the company's story, but it's written in the language of business, finance. And by the time we're done here, you'll get the basics of that language too.
So here's what we'll cover. We'll start with what these things called financial statements even are. Then we'll get into the two big ones, the income statement and the balance sheet. After that, we'll look at how this stuff is used to make actual business decisions. And finally, I'll walk you through a couple of common pitfalls that, once you see them, you'll sidestep like a pro.
Okay, so how does a business tell the world how it's doing? It can't just send out a press release saying, hey, things are great. No, it has to publish an official, standardized report card. And that's exactly what financial statements are.
Think of them like this. They're the official, rule-based summary of every financial move a business has made. They're the end result of all the accounting, and they're designed to give a really clear picture of both its health and its performance.
Now, there are a few of these reports, but we're going to focus on the two heavy hitters, the two that answer the biggest questions you can ask about a business. First, how did you do over a stretch of time? And second, where do you stand financially on one specific day?
Let's tackle that first question, performance over time. For that, we turn to something called the income statement. And honestly, the best way to wrap your head around this is to think of it as a movie. Here's the key difference, right here. The income statement is a video. It plays out the story of what a company sold and what it spent over a whole period, like an entire year. The balance sheet, which we'll look at in a minute, is completely different. It's a snapshot, just a single photograph of the company's finances on one single day. So what this movie really tells you, and you might also hear it called a P&L, for profit and loss, is whether the company actually made or lost money during that period. It's all about profitability over time. And the math behind it is just beautifully simple. You start at the top with all the money that came in from sales, we call that revenue. Then you subtract all the money that went out the door to run the business, salaries, rent, materials. Whatever's left at the very end, that's your net income. That's the profit.
You're going to hear people in business talk about the top line all the time. When they say that, they're just talking about revenue. Why? Because it's literally the first line, the top line on the income statement. It's where the whole story starts.
Let's make this super simple. Picture a little local bakery. In 1 year, it sells $50,000 worth of bread and cakes. That's its revenue, the top line. But of course, it had to spend money to make that happen. $40,000 on flour, rent, and paying the baker. Those are its expenses. You subtract the 40 from the 50, and you're left with a $10,000 profit. That right there is the movie of the bakery's year.
Okay, so we've watched the movie. Now it's time to look at the snapshot. This is the balance sheet. And this answers that second question we had. What's the company's exact financial position at one single moment in time?
See, unlike the income statement, which covers a whole year, a balance sheet will have a specific date on it, like December 31st. It tells you exactly what the company owned and what it owed on that specific day.
The balance sheet is built on three main things. First, you have assets. That's all the valuable stuff the company owns, like cash in the bank or its delivery van. Second, liabilities. That's all the stuff it owes to other people, like a loan from the bank. And third, there's equity. This is what belongs to the owners. It's basically what would be left if you sold all the assets and paid off all the liabilities.
And here's the really cool part, and it's why it's called a balance sheet. It always has to balance. The assets on one side have to perfectly equal the liabilities plus the equity on the other side. Think about it. What you own has to equal what you owe to others plus what belongs to the owners. It's a perfect equation every single time. So you might be thinking, okay, a movie and a snapshot. Why do I need both? Well, because when you put them together, they become the foundation for making huge business decisions every day.
Let's go back to our little bakery. Business is booming, and the owner wants to open a second shop. To do that, she's going to need a loan. So she goes to the bank, and what's the very first thing the loan officer asks for? You guessed it, her financial statements.
So what is that banker really looking for? Well, first they grab the income statement, the movie, to see, is this bakery profitable? Can it make enough money to pay us back? But that's not the whole story. Then they look at the balance sheet, the snapshot, to ask, is this business stable, or is it already drowning in debt? See, one shows potential, the other shows stability, and a bank needs to see both before they're going to write a check.
Okay, now that you've got the basics down, let's talk about two classic mistakes that trip people up. If you can avoid these, you'll be way ahead of the curve. The biggest mistake by far is thinking that profit is the same thing as cash. It is not. Let's say our bakery sells a giant $5,000 wedding cake in December. The income statement for that year looks amazing, right? But what if the couple doesn't actually pay for it until February? In January, the bakery has rent due and a baker to pay, but has zero cash from that sale. This is absolutely critical. A company can look amazingly profitable on paper and still go bankrupt because it ran out of actual cash.
The second big mistake is just looking at one of these reports by itself. If you only look at the income statement, you might see a company making tons of profit and think, wow. But what if you then looked at the balance sheet and saw it had 10 times that amount in debt? One report tells you how the business is performing, the other tells you how stable it is. You absolutely need both to see the whole picture.
So if you're going to remember just one thing from all of this, make it this. The income statement is the movie of a company's story over time. The balance sheet is the snapshot of its health on one single day. And there you have it. You now have the keys to unlock the real story behind any business. So think about a company you're interested in. Maybe it's where you work or just a brand you love. Their story is out there in these reports, just waiting for you. Now that you know the language, which story are you going to read first?